Hi everybody, hope you're doing well. In this video, we're going to lay down some foundational material to help us look at some more of the impacts of coronavirus. And to do that, we're going to be looking at the monetary system. That's going to allow us to talk about monetary policy. That's going to allow us to understand how monetary policy is going to affect things like the bond market. And so going to lay down these foundations first, and then we'll move on to kind of traditional kind of go-to monetary policy, open market operations. And then we'll talk about the stock market and bond market and some of the financial impacts of coronavirus. Okay, so we in this video, we've got a little outline here. We're going to talk about money, the functions of money, the money supply, and ultimately a little introduction to the Federal Reserve System and how they're influencing the money supply through their monetary policy. As you can see, there are a couple free resources online, OpenStax, free open source textbooks in the Principles of Macroeconomics textbook, chapter 14, has some of the information about the monetary system, and the economics library always has great resources as well. Okay, so let's jump in here. Starting here with money, looking at how we use money. What are the functions of money? Although the way that we use money now, paper money, dollars, and so forth, isn't the only system that could be used to kind of have activity within an economy. An alternative system could be bartering. But the problem with bartering is that so we're not using money, we're just trading goods for goods. You know, if I want some chickens, I'll trade, my goat for some chickens. Or I mean, even in a more modern context, if I want if I want some work done on my house, I could trade my boat or something for the services of a carpenter. But it's just trading goods and services for other goods and services instead of using the intermediary money option. So again, the problem with bartering is that we have this double coincidence of wants. Okay, and so that's a situation in which two people, you need to have a situation in which two people each want some good or service that the other can provide. So they each want some good or service that the other can provide. Okay, so if I want chicken and I have a goat to give, that also means that the chicken farmer needs to have chickens and also wants to have a goat. So both of us need to have a coincidence that the other person wants what we have. And so this is necessary in barter economies. And it makes trade difficult. That's one of the reasons that having some type of money, some type of currency, is useful. But there are even kind of more functions of money that are even more useful. So moving on to these functions of money, the stock of assets that can be readily used for transaction. We think primarily of dollars, but we'll talk about some other alternatives. So the functions of money. One is a medium of exchange. Okay, so we use it to buy things. So if I want some eggs, or no, what did I want? I want chicken. If I want some chicken, and I have a goat to give, I can sell my goat to somebody who wants a goat, anybody, for cash, for money, and then now I have some money, and with that money I can buy other things like the chickens or whatever else. So it serves as this medium of exchange. It serves as a store of value. A dollar today is worth something close to a dollar tomorrow and next year, and so on and so forth, as long as inflation is relatively under control. And so store of value, and then finally a unit of account. And so in this way, we're talking about, we price things in terms of dollars. That gives us some idea about how much things are worth. Okay, so a medium of exchange, store of value, and unit of account are the functions of money. And now talking about different kinds of money, we could have commodity money or fiat money. We happen to have fiat money, so we'll get to that in a second. But let's talk about commodity money first. So this is an item used as money, but also has value from its use as something else. So an item that is used as money, an item that is used as money, but also has value from its use as something else. But also has value from its use as something else. Most common examples, so some examples here. Most common examples of this would be precious metals, so in particular gold and silver as commodities. And but we have some other things that have been used in the past too. Salt has been used, shells have been used, cocoa beans. In prisons, cigarettes have been used. So the list goes on. A number of things have been used as commodity money. Okay, now fiat money. So fiat money is essentially just paper money. There's sort of an intermediary step where you have commodity-backed fiat money, commodity-backed paper. So, for example, gold-backed dollars. Although we don't have that anymore, we just have straight fiat money, paper money, not backed by gold. My dollar, in my pocket is not the equivalent of so many ounces of gold sitting in a treasury somewhere. It's just a dollar in my pocket. And this is money with no intrinsic value. With no intrinsic value. But declared by a government as the country's legal tender. But declared by a government as the country's legal tender. Okay, examples here are what we think of today as currencies. So US dollars, euros, etc. Almost all national currencies. And so these just are backed by the government and essentially exist built on the trust that that a bank can take them, and then the bank will take them because they know that they can deposit it into the Federal Reserve. And so the trust of the government, the trust of the national currency, is what keeps it to have any value at all. Of course, if that breaks down, then it leads to problems. And so that's what happens in a lot of country level defaults, or even something like what happened in Zimbabwe with their hyperinflation. The trust in the currency just totally lost its value. Hyperinflation in the millions of percent, and ultimately they disbanded their currency and just adopted the dollar. So for most developed countries, however, fiat money works quite well. Now we're going to move on to the money supply and a couple different ways in which we can measure that. Ultimately, it's the amount of money that exists in an economy, and we have a few different ways that we can measure that, and each of these ways are using different levels of liquidity. Liquidity is just the ease with which an asset can be converted to cash. The ease with which an asset can be converted to cash. Okay, and so if we think about some assets with very high levels of liquidity, very easily converted to cash, down to low levels of liquidity. Well, first of all, the most liquid thing is cash itself. That's our most liquid asset. Other things that are quite liquid could be things like stocks and bonds, especially bonds, government bonds anyway, to some degree, cryptocurrencies, and gold is actually pretty liquid too. So if you hold stocks, or if you hold bonds or gold, if I have a bond and I want to convert it into cash, when the markets are open, I can just sell it, and then those proceeds from the sale go back into my bank account, and then I can access the cash out of my bank account. So these can be sold relatively easily and converted back into cash. Some larger and illiquid assets could be something like a house, right? Where if I want to convert my house into cash, it's going to be timely, it's going to be costly, and it's really not as simple to sell as something like a bond and convert back into cash. And yeah, there are also costs to that. So houses, cars, land, basically a lot of durable type assets. Much more costly and timely to convert back into cash. So that gives you an idea about liquidity, and then now we'll talk about it in the context of how we measure the money supply. So there are three different measures of the money supply: M1, M2, M3. M1 and M2 are typically the most commonly used. And again, on the kind of liquidity scale, the M1 money supply is the most liquid. The M3 money supply is the least liquid. And so if we get into each one, M1 includes currency, so cash, US dollars, right? Currency, DDAs, which stands for demand deposit accounts. But essentially, all that means is that's a checking account. So you can access your money on demand out of your checking account. You can go to an ATM, you can go into the bank, you can use your debit card just as you would with cash. So essentially, they're very liquid. They're used almost the same as cash if needed, and can be converted into cash as well very easily. So currency, checking accounts. Let's put checking accounts. And traveler's checks. I think that might be with a Q. I'm not sure. But traveler's checks, not so common nowadays, but also can be converted into cash by just taking it into a bank. So pretty liquid. So M1 is a very kind of liquid measurement of the money supply. M2 includes all of M1, and so we're just going to be adding to it. So we have all of M1, currency, checking accounts, DDAs, and so on and so forth, plus savings accounts, SAVs. Let's just put SAV. Savings accounts. We've got money market mutual funds. Money market mutual funds. And small time deposits. And a time deposit is essentially just a CD. So short-term mutual funds, money market are short-term type funds, and small time deposits. These are going to be things like a 6-month CD or maybe a 12-month CD. Very short-term types of savings accounts. Okay, also fairly liquid, although not quite as liquid and a bit slower to convert into cash than something like a checking account. And the last one, M3, is all of M2, which means that also includes all of M1. So all of M1, all of M2, plus large time deposits. So longer term CDs, and long-term bonds. For example, a 30-year government bond, T-bond, treasury bond. Okay, so those are some examples of what would be included in these different measurements of the money supply. So we have all these different types of assets. The money supply isn't all held just in currency. We have a whole lot of our money held in other types of assets, and these are just different ways to measure it. So, but long story short is that we're going to be using the money supply. Well, the Fed is going to be using the money supply to help influence interest rates in the economy. And by influencing interest rates, that's going to impact kind of different policies on how we can get out of recessions. If we want to speed up growth or even potentially slow down growth, then monetary policy is going to be trying to influence the money supply. Okay, and so with that, let's move on to the Federal Reserve System. So the Federal Reserve, or just the Fed, I'll probably say that a lot. So if I say the Fed, I mean the Federal Reserve System. It doesn't mean the federal government or Congress or anything like that. The Fed is the central bank of the United States. And so central banks, they're supposed to be apolitical, and often they are apolitical institutions with kind of no party attachment. And they oversee the banking system. They do a lot of banking regulation. They influence the money supply, and they're primarily in charge of conducting monetary policy, whereas Congress is conducting fiscal policy. So changing around government spending and taxes and all that. A couple other examples of central banks. We have the ECB, which is the European Central Bank. And then a lot of other individual countries have their own. Almost most other kind of non-European countries, they have their own central banks. So China, their own central bank. Japan, their own central bank. Things like that. Okay, but we're going to focus on the U.S.'s central bank, the Fed, created in 1914 after a lot of bank failures, run by the Board of Governors. So Board of Governors include 7 members in Washington, D.C. And these members are appointed by the president, and confirmed by the Senate. And these members serve 14-year terms. One of these members is the chairman or the chairwoman, and they serve 4-year terms, which can be renewed. Our previous chairwoman, actually the first chairwoman ever, was Janet Yellen. First chairwoman. Before that, we had Ben Bernanke. Ben Bernanke was the chairman during the 2007-8-9 financial crisis and recession. But then our current chairman is Jerome Powell. And he started in February of 2018. Okay, so that's our current chair. He's actually been in the news a lot lately because there's been a lot of monetary policy action going on recently. And so we'll come back to some of that in a little bit. But we have the rest of the Federal Reserve System. So in addition to the Board of Governors, we have 12 regional Federal Reserve banks. So Colorado, we're in the Kansas City Fed district. And maybe I'll throw up a map so you can see all the districts around the country. Most are following state borders, but actually some of them cut states in half. That's actually made for some really great research in the past, where one district takes one policy, another district takes another policy, but within the same state, you have 2 different policies. And so anyway, that's a bit of a tangent. So let's move on. Going to the Federal Open Market Committee, the FOMC. This committee is the one in charge of making all the monetary decisions, doing all the monetary policy, and it's composed of 12 members. It always has these 7 Board of Governors members. And then out of the 12 regional Federal Reserve banks, it always has the New York Fed president. For somewhat obvious reasons, the stock exchange and the actually international hub of financial markets being in New York City. So the New York Fed is always a part of this board. And then we have 11 regional Federal Reserve banks left. And so we have the last 4 members are 4 of the 11 remaining regional bank presidents. Regional bank presidents. And these 4 members rotate every year. So that adds up to the 12 members of the Federal Open Market Committee. Okay. So last thing is just a brief introduction to the Fed's monetary policy tools. I'll just introduce them here, and we'll have a separate video that gets into the details of these. But it can influence the discount rate, the reserve requirements for banks. Open market operations is the big one. And actually more recently, some advanced monetary policy tools. You may have heard of quantitative easing, and there have been some kind of loan type programs coming out of the Fed when these traditional open market operations aren't effective, which they are approaching the limit to where they have reached the limit, to where normal open market operations can be effective. We'll talk about that later. But let me just introduce these briefly, and then that'll be it for this video, and then we'll pick it back up with the next video. So suppose the Fed wants to increase the money supply, and actually let me introduce this very briefly, just to know that if we want to spur the economy forward, promote economic growth, we can increase the money supply. That's expansionary. Let's put that down. Expansionary monetary policy. We want to expand or strengthen the economy. To do that, we want to increase the money supply. Why? Let's look at a little supply and demand graph. I'll do it again in a future video, but I'll just introduce it here. Here we have R, the interest rate, R. And here we have M, the money supply. Interest rate is going to be a downward sloping function. Essentially kind of the demand, a demand type curve, and then the money supply, M0, is M. So here we could have the supply of money and the demand for money, a function of the interest rate. So, well, shoot, let's put this over here. M0, the supply of money. If we want to, and we have our equilibrium interest rate, R0, let's say that's 1%. So the economy is doing poorly. We want to increase economic activity. One way to do that is for the Federal Reserve to conduct some monetary policy, expansionary monetary policy, to increase the money supply. By doing so, the equilibrium interest rate decreases 0.5%, R1. So if the interest rate, so money supply goes up, that means the interest rate goes down. If the interest rate goes down across the economy, couple things are going to happen. We've talked about GDP in the past. GDP equals C plus I plus G plus net exports. If the interest rate goes down, investment, interest rate goes down, cost of borrowing goes down. So if it's cheaper to borrow, businesses can borrow more to invest. So investment can go up. Also, if it's cheaper to borrow, people can borrow money to buy cars or buy houses. And if people buy cars or houses, particularly houses, that's going to be putting potentially construction workers to work, carpenters, repairmen, all sorts of people having these kind of downstream effects on the economy. So consumption goes up. And so and potentially a couple of these others will have some effects, but essentially if these go up, GDP goes up. So we initially increase the money supply, and that leads to an increase in GDP. And so this is expansionary policy. This is what we want to be doing during times of recession, like now, and this is what we have been doing. So a few different ways to do this, like we saw up here. Let's talk about each of these. Well, let's talk about these first three anyway. So if we want to increase the money supply, we have the discount rate. So the Fed could decrease the discount rate. The Fed could, for reserve requirements, decrease reserve requirements. Or use open market operations to buy government bonds. To buy government bonds. Right? If the Fed is buying bonds, they're using dollars to buy those bonds. So the dollars they're using are going to the sellers. The dollars are going out into the economy by buying government bonds. And so, again, this is the most common one. But these are what can be done. And again, let's go into just a little bit more detail on each one of these. And then in the next video, we'll talk about them in even more detail. But again, open market operations, traditionally the most commonly used monetary policy tool. Okay, but going into here, the discount rate is one of the rates at which banks can borrow money from the Fed. One of the rates at which banks can borrow money from the Fed. Okay, so if the Fed reduces their rate, banks borrow more money at a smaller cost, and then the banks can then offer loans at a smaller cost to their customers. And so again, money supply increases, investment and consumption go up, GDP goes up. So discount rate, first one, reserve requirements. Reserve requirements dictate how much of a bank's deposits must be held as reserves. So reserve requirements dictate how much of a bank's deposits must be held as reserves. Must be held as reserves. And so, banks take a lot of deposits from customers, and then they can lend that money out to people who want loans, right? And so, there are requirements on how many of those deposits banks can lend out. Although actually for most banks in the economy, the reserve requirement is 0. So technically they could take all the deposits and make loans. But obviously banks keep some of their deposits on reserve in their vault or on reserve at the regional Federal Reserve Bank. We'll talk in more detail about this one as well. But reserve requirements You lower that if take for an example, if banks had a 10% reserve requirement, that means if they had 100 deposits, 10 of those would have to be held in their vault. That means only 90% can be lent out. But if you decrease the reserve requirement to 0, then out of those 100 loans, 0 are held as deposits. All of that gets lent out into the economy, increasing the money supply, increasing the amount of money circulating around. So we'll go into more detail onto this later. But you decrease the reserve requirements, that's going to increase the money supply. And then finally, open market operations, the big one, is when the Fed buys or possibly sells treasury securities to increase, or if you sell, to decrease the money supply. And this influences the federal funds rate. And when I say, I guess, influences, it decreases, or if you're selling, increases the federal funds rate. And so that interest rate is kind of one of the fundamental interest rates in the economy, around which all the other interest rates follow. So if the federal funds rate goes down, that's going to ultimately lead to interest rates for normal customers on business loans, on car loans, home loans. Those are also going to decrease. So it's the Fed buying up treasury securities. In the traditional sense, it's typically short-term government bonds. And so these are open market operations. These we'll talk about in a bit more detail in the future video, as well as some of the more advanced monetary policy tools. Okay, so this just gives a little introduction to the monetary system, the Federal Reserve System, and a brief introduction to these monetary policy tools. And to be able to talk about future monetary policy and also the bond market, these are usually short-term government bonds, we'll be able to use this information from this video to kind of guide us as we talk about monetary policy and as we talk about financial markets.